Welcome everybody to our first webcast for the financial planning discussion group hosted by the local chapter of the Silicon Valley AAII. Tonight we're going to be talking about Social Security and Medicare. Standard disclaimer. Okay, so for the financial planning group, we have a cycle that we go through every season, from September through June. We run 10 meetings. Okay, for tonight we're covering Social Security. We'll look first of all at the various benefits and how you can sign up for those either for at your full retirement age or early or late. We also look at the different benefits that are available depending on whether you're looking for retirement benefits as a worker or whether you're looking as a spouse or a survivor or a divorced spouse. There are different rules for all of those, and I'll cover most of those in a bit more detail. We're going to look at claiming strategies for both single people and married couples. Married couples, actually, single people is fairly straightforward. Married couples, there are some interesting options that we'll be talking about. And then we're going to get into the Medicare parts A, B, C, and D. And we're going to look at a slide that compares traditional Medicare with Medicare Advantage, the pros and cons of each. And then we'll wrap up with what I call the seven Medicare myths, and hopefully show you what the real data is on those. Okay, the little background on Social Security first. It was enacted by Franklin Roosevelt in 1935 in the Social Security Act. At that time, I love this, it was funded by 2% of the first $3,000 in earnings. The benefits only went to the workers, and there were actually, at that time, a ratio of 7 workers per retiree. Also at that time, the retirement age then was age 65, which was the case here until recently. But the big difference is that you were expected to have the good grace to only retire for 5 years. So that has changed a lot. The life expectancy has changed very, very significantly since that. Other benefits have all been added over the years. Different administrations have chosen to add in different bits and pieces of this. So kind of like Topsy has grown. There's spouse, minor children, COLAs been added. Medicare is one of the big issues that got added. SSI, or Supplemental Security Income, which is added, I guess, a few decades ago. And the sort of welfare program, Temporary Assistance for Needy Families, TANF. The current funding is way, way different to what it was back in 1935. We're now tagging folks with 6.2% of their earnings up to a cap value for 2020 of $137,000 and change. That's just for the Social Security part of it, and then on top of that, there's a 1.45 adder for Medicare, and the employer gets to match both of those. If you're self-employed, you get to cover both sides of it, which brings you up to a total of about, I think it's 15.3%. So it's a very significant tax hit.
Historically, it's kind of interesting. You didn't actually receive your benefits immediately. There was just like today, I think there's this delusion that you're actually contributing to something or, a trust fund. Just the same applied back in 1935, and it took some years before you actually received benefits. And it was with the thinking that, well, I'm contributing, taxes, and I'm building into this trust fund, and then in the early 40s, if I turn 65, then I can receive benefits. And the initial benefits were $20 a month.
Well, that could have been a goodly sum at the time. But you're right. Some folks have the misconception that they're contributing, that their FICA is going, their 6.2% is going into an account with their name on it, and they're going to get that back. In reality, then as now, today is still the same. The payouts today are coming from the income that's coming in today. It's there's no fund with your name on it that you have the right to the fund no matter what happens.
Ponzi scheme comes to mind.
Absolutely, it's a legal Ponzi scheme. Yes, you're absolutely right. So how do we calculate the retirement benefits? First of all, you have to have contributed for at least 40 quarters. I think that's supposed to be different to 10 years. It doesn't have to be 10 consecutive calendar years, but you must have contributed for 40 quarters. And the maximum wages are capped for 2020 at 137,700. Beyond that, they don't take anything out of your paycheck other than for Medicare. The Medicare payments continue indefinitely. When they're looking at your record of payments up to age 60, all the previous years are the contributions are adjusted for inflation. So they do an inflation adjustment up to age 60 and then take the current values from age 61 onwards, the actual unadjusted values, and then they take the best 35 years out of that basis and take the average monthly payment over those 35 years. Now, if you have not worked for 35 years, if you have not made contributions for 35 years, then they backfill the number of months with zeros, which obviously drags down your average. So it's worthwhile striving mightily to at least get 35 years in there. And even when you get 35 years, it can still be worthwhile continuing to work if you're so inclined, because some of the recent years may turn out to be a better contribution than the early years. So you can bump up your payment that way. So when you get the AIM, the average index monthly earnings, when you get that calculated, then you have to look at how to crank out the primary insurance amount, the PIA. And in passing, I think that seems to connote some other, be a short form of some other designation. We'll take it as the primary insurance amount here. The computation shows you take 90% of the first 960 plus, et cetera, et cetera. You can see it on the slide. They have this crazy formula that they use to calculate the primary insurance amount, and that's the amount that you get on a monthly basis at your full retirement age. So everything hinges on the full retirement age. So how do you know what your full retirement age is? Back in the early days, it was 65 up to 1937. I guess for many, many years, it was 65. And then it gradually crept up at 2 months for each year increased up to 66. And then at 1955, it was 66 and 2 months. And then it gradually crept up to 67. So if your year of the birth is 1960 or after, your full retirement age will be 67. Now, if you take your retirement benefits at the full retirement age, you get the primary amount that we calculated a couple of slides back, but you can take it earlier if you so choose. And if you take it earlier, they've got this crazy formula for reducing the amount depending on how many months early you take it. You lose 0.05% per month for the first 36 months that you're taking it early. And then on top of that, you lose 0.05% per month for anything beyond the 36 months. The simple way of looking at it is that if your full retirement age is 66 and you choose to take it at 62, that's 48 months early. And then under those conditions, it works out that you lose exactly 25% of it. That's the easiest rule of thumb to remember. If you take it at age 62, chances are you're likely to lose 1/4 of the monthly benefits. Going in the other direction, you get a credit of 8% per annum for each year that you delay taking your benefits up to age 70. Now, there's no benefit going beyond age 70. So again, if your full retirement age is 66 you get a 32% bump if you delay the 4 years to age 70. And just in passing, if you neglect or if there's an oversight that you don't make the claim when you intended to do, you can collect retroactive benefits for up to 6 months. Beyond that, you're out of luck.
The calculation for the late retirement is by month and not required by year, right? So if you delay.
That is true. That's correct. It doesn't have to be a whole number of years. You're absolutely correct.
I'm wondering if everyone on the call gets their annual statement from mysocialsecurity.gov or whatever the thing is, because there's an online site you can go to and look at your most recent earnings and what your expected payments would be if you retire at different ages. They calculate it on your, the information they have. And you might want to check that every year. So you
good comment, Holly. I agree. It's useful before you retire just to check on what you're likely to get later, but also to check that they got the current and prior years registered correctly, accurately. After you've retired, or at any point, it's useful to check it from time to time, just to avoid fraud. There have been some instances where people have tapped into that account and played games with names and addresses, and it's kind of recommended that you log onto that account from time to time just to make sure that it still looks good to you. This graphic here is just for information only. It's not meant to be don't take the numbers too literally. What I did here was start with somebody with a benefit, a full retirement age benefit, a PIA of $1,000 a month, and see what that would look like if they were to start taking their benefits early and then at full retirement age and then later. If they take it early, they'll only get $750 a month, and as they age, they'll go up the red line that I've shown on that goes out to, it actually goes out to age 100. The scale doesn't quite make it. And that's what it would look like. For those folks who would like to wait for the approximately 4 years to the full retirement age, the blue dotted line is what would happen. So they obviously start later, but it's a steeper curve. So if they live a long time, they do better in the end. And then those folks who wait for the late retirement, obviously don't start until age 70, and the green line goes up as the steepest line and has the biggest benefit if you're lucky enough to live into old age, into your 90s or to 100. So it's just meant to indicate the slopes of the various lines, and they all cross over in the early 80s. That's no coincidence, because at the time this was done, the expected lifetime for American citizens would have been in the early 80s. So they cross over roughly at the expected lifetime. So it's a kind of a challenge to figure which line you want to be on. And Susan pointed this out earlier. Some of the complications that come into it go way beyond the financial questions. One of the first things you have to ask yourself is what your own health is like. Then you need to look into what the history of your family health is like, because if you get the wrong answers on these and may not live to past your early or mid 80s, then you might want to consider the taking early retirement. If, on the other hand, your grandparents all live to be well into their 90s, and you're in good health yourself and expect to meet or exceed their lifespan, then that could be weighted towards the late retirement. But I just wanted to make it clear that it's not just a financial issue. There are other issues that come in here too. The same thing goes for most financial planning, by the way. Financial planning folks think of as pushing numbers around on a spreadsheet with dollar signs in front of them. Most of the big questions on financial planning do not have dollar signs in front of them at all, but that's a separate issue. We'll talk about that actually next month with estate planning in particular. Okay, upward and onward. I'm going to look at the benefits for a number of different folks. What we've done so far are the retirement benefits for the worker. That's what we've been talking about so far. Now I'm going to look at spousal benefits, and the requirement to receive spousal benefits is that the worker must, I'm assuming that one spouse is working and the other one is not. The worker must be actually receiving retirement benefits, and that's relatively recent. That was not the case 3 or 4 years ago. It opened up all sorts of great opportunities to file and then delay taking benefits. But now the current law means that the worker must be actually receiving benefits, and at full retirement age, the spouse can take their own 100% of their own benefit if they want, or if the worker's benefit, if 50% of the worker's benefit is available as well. No, I shouldn't say as well, instead, whichever they want. They're obviously not going to get both. So 50% of the worker's benefit is there for the taking if the spouse wants, regardless of his or her actual work history, himself or herself. The spousal benefits can be taken early, the same way as the regular retirement benefits, but again, there's a catch, and it's even more complicated here. You lose 25, 36 of 1% per month for the first 36 months, and 5/12 of 1% per month beyond that. Again, the simple form of it is that if your full retirement age is 66 and you want to take spousal benefits at age 62, then you will lose 30% of the 50% of the full of the workers' benefits that you would normally get at full retirement age. So you basically lose you lose 30% of it. Back in 2015, the Bipartisan Budget Act, I've got a typo here, I like it as the Budge Act, eliminated the strategy of filing a restricted claim for spousal benefits only. Prior to that, you could file for spousal benefits and get those while delaying your own benefits to age 70 to get the greater amount. But in 2015, the Obama administration killed that one. Survivor benefits. Requirements are that the marriage must have lasted at least 9 months. I don't know why they picked 9 months, but it is what it is. The survivor must be at least 60 years old to claim survivor benefits. Again, I'm not sure why they keep introducing different formulas, different dates, different number of years, and so on. But I would have thought this would have been 62, but it's actually 60. If they're disabled, they can claim as early as age 50. And the survivor must not have remarried in order to claim the survivor benefits unless after age 60. So it's you got to watch what happens in your old age. Survivor benefits claimed at full retirement age are equal to the deceased spouse's full benefit, and that includes any additional credits that they got for delaying to age 70, assuming that they're greater than the survivor's own benefit. If the survivor's own benefit is greater than the deceased spouse's benefit, they obviously take their own. The actual law is written that what the survivor gets is not the greater of the two benefits. They actually get their own benefits first, and then they get the delta to make it up to the survivor's level if that were higher. It means they are legally tapping into their own account first. But the Social Security Office bumps up, gives you a delta to bump it up to the same level that the deceased spouse had been earning beforehand. Again, reduced benefits can be collected as early as age 60. And again, there's a complicated formula that I didn't go into here. Divorced spouses can collect benefits, but again, there are requirements. You must have been married for at least 10 years. You must not have remarried. If you get remarried, then you forfeit the right to collect the divorced spouse's benefits from that spouse. I guess you're kind of tacking onto the new spouse and whatever benefits may or may not accrue from that. The interesting thing though here is that the ex-spouse's benefits are not affected, and they need not have actually filed yet. And the other thing I find interesting is they don't even have to know that you've tapped into their benefits. It's got no effect on them, so there's no reason why they should know. But it's kind of neat in one way to be able to reach your hand into your ex-spouse's benefit package and pull dollars out without him or her knowing about it. It's a little freaky. The other thing that's interesting about this law is that both an ex-spouse and a widow or widower are entitled to survivor benefits simultaneously, provided obviously that they each qualify on the rules that we've just discussed. If you work it out, somebody, this is a little, if you got some guy that's gotten married 3 or 4 times in the past, and in each case the marriage has lasted for 10 years, you could in fact have 3 or 4 ex-spouses and 1 or 2 widowers all entitled to pull benefits from his account. Yeah, that's a little bit of a stretch, but it's legally possible. I'm surprised that the law allows this to happen, but well, it is what it is. So if it's of any benefit to anybody, great. I'm just checking the chat window here again to see if there's anything else that needs to be addressed. Deborah has commented that is there a limit of 6 retroactive benefits if a file and immediate suspend is done? It's 6 months, I think, is the legal requirement.
I thought the 6 months was if you hadn't filed. I've heard some recommendations that you should file and suspend, and that would give you more options if something goes wrong.
Oh, you may be right. That used to be the case. I'm not sure if it still is. It used to be that there was a benefit to file and suspend rather than just not claiming, in that it did give you the option to go back at it, 2 or 3 years later if circumstances changed. I don't know if it still holds, Deborah. I don't know. We'd have to look that one up. I know that if you do not file and suspend, the 6-month window is a hard one. Okay, so it's not clear in my mind what an optimal claiming strategy could be. I can see at least 2 rational ones that might make sense. One might be for the person who wants to maximize what they pull out of the system. It basically argues, I want to get the most out of the system that I can, allowing for my expected adjustment for age and for health and family history and all the rest of it. I just want to make sure that I get as much out as I can. The other totally separate argument may or may not lead to the same conclusion. Sometimes does, sometimes doesn't. Some folks may want to say that in case they live a long time, they want to, their primary concern is to minimize longevity risk. They want to maximize the benefits they get later in life, regardless of what happens earlier in life. They're in essence arguing, if I die early, I don't care a damn about the money part of it. That's not a problem anymore. And if I survive to my 90s or 100, then money may be a problem. And under those conditions, I want to optimize the benefits so I don't run out of money. So I think before you start, this is getting back to what Susan was asking earlier, I think before you try to figure the detailed strategy that you want, you need to kind of figure what parameter you want to optimize. There may be others and beyond the 2 that I've shown here. In my personal case, I happen to belong to the school that goes with item 2 here. If I die early, it's tough on me and the family maybe, but it won't be a money issue. But if I live to 100, that's when my retirement portfolio is going to be stretched to the limit, and along with everything else. And I made the very careful decision to optimize my benefits later in life, to wait until age 70 to claim. When should a single person, now we're getting again to what Susan had asked earlier. For a single person, it's a fairly straightforward decision. And the decision depends mostly on two items: whether you need the money and what your health is, and the health of the family health history. If you need the money, then you got no choice. It doesn't matter what the optimum strategy is. You're going to take the money now, so you're going to file early. If you're in poor health now, or if you have a family history that's not that great, you may want to consider filing early as well. I mean, in other words, if you don't expect to live beyond the crossover point on the graph that I showed earlier, then you might want to elect to take the benefits early, even if there's the risk that you beat the odds and live to your 90s anyway. If neither of those issues is a problem, then I would suggest you should certainly consider delaying benefits at least to full retirement age. I would say probably to age 70. Again, it's a personal issue, and you got to look at your personal issues as well as the financial ones. It also does depend on whether you're planning to still work or not, and we'll deal with that in a few minutes later. If you're working, it complicates things. Well, it simplifies the decision, but it complicates the math a bit. For married couples, the decision gets a little more complicated. The first thing you got to realize is that Social Security is the equivalent to a joint annuity. You're not just dealing with yourself. You're dealing. It's a joint annuity where the survivor gets benefits as well. As we discussed earlier, the surviving spouse receives the larger, or the equivalent of the larger of his or her own benefits, or the deceased spouse's benefits, 100% of the deceased spouse's benefits. And if you do the simple math, anybody plays games with probability, there's a 50-50 chance that that each spouse is going to live to the average life expectancy. So there's a 25% chance that both spouses will die prior to the average life expectancy. Given that, there's a 75% chance that at least one will live longer. And if you look at it that way, it kind of points towards having at least one spouse delay taking the retirement benefits to maximize them to age 70. Unless both spouses have health problems, for most couples, I think it makes sense to delay to age 70. If both have health issues, then the same sort of argument applies that we looked at for the single spouse, single person. If you delay taking, if the higher earning spouse delays taking the benefits to age 70, then obviously the surviving spouse, regardless of which spouse dies first, the surviving spouse gets the benefit of those higher earnings. So there's a fairly strong incentive, I think, based on that alone, to consider having the higher earning spouse delay. There's another issue that sort of comes in here as well. Maybe it's a secondary effect. The curves that I showed you in that little graph earlier crossed over in the early 80s. But that was then, and this is now. I think that was from Social Security data from a decade or two ago. The life expectancy is creeping out every year that passes, and it's now in the mid 80s. I think actually for women, the life expectancy is somewhere up in the 86 or 87 range, and perhaps a little lower by 2 or 3 years for men, but it's certainly beyond the low 80s. And that puts, again, a bias on, if the Social Security is using a crossover that's lower than the real numbers, that's again a reason to bias your decision towards the delaying the receiving benefits.
Asok was just questioning whether you could file and suspend after the 2017 where it was eliminated for spousal benefits, but it's not for your own, where if you've claimed before 70, you can still suspend for a time and increase your benefits.
Yes, yes.
So why would you do that? Is it because you fear some political cutbacks to the program, or why?
Do I detect a cynic in the group?
Yes.
Your finances may have changed. Anything could have happened.
Things change, Holly. Whatever decision you make at age 62 or 3 or 4, whatever, to delay or not delay or whatever, are made at that point in time. And maybe at age 62, you're in great health and you figure, I'm going to live to 95 or 100, so I'm definitely going to delay until age 70. But you may unfortunately have a doctor's visit that gives you a wrong answer at age 63 or age 65 or something, where you might say, geez, that decision wasn't that great. I'd like to change my mind. In fact, let me go on. I think we're looking at some. I'll follow up on that in a minute. I have a slide or two on what happens if you change your mind. So remind me when we get back to that, and we'll come back to it. If you want to continue working, you can theoretically take your benefits early if you want to, or if you need to for cash flow reasons, but you take a pretty serious hit. Before the year in which your full retirement age hits, you're going to lose $1 for every $2 earned above a pretty low cap of $18,240 for 2020. I kind of put shorthand in here a little bit. When I said before full retirement age, what that really means is before the year in which you reach full retirement age. And when I said lose $1, you don't actually lose it, as we'll see in a minute. During the months of your the year in which you reach full retirement age, prior to actually reaching that month, you only lose $1 for every 3 with a higher cap. And then after you hit the month with your actual full retirement age, then there's no further reduction in benefits. So the paycheck that you get, the benefits that you get from Social Security will be fairly severely curtailed if you're working and earning above the caps that I've shown here. But it's still income if you need it. So some folks may be forced into a box where they need to do it. The money is not lost. Any reduction that you take during those years, you basically get back. It's restored by the SSA by bumping up your benefits to a higher number to allow for that, to factor that in after you've reached full retirement age. But for the 3 or 4 years or whatever prior to full retirement age, if you're working, then you will not get the benefit that you might have initially thought you would. The bottom line, I think, for most people is that if you plan to keep working, most people are not going to want to bother trying to claim any early benefits. It's just not worth the hassle of working through all this for a fairly minimal return unless you desperately need it. And of course, Social Security benefits may be taxable. You first have to calculate your combined income. It's sometimes called the provisional income. You may see either term. It's equal to the AGI, your annual gross income from your 1040, plus the tax exempt interest, for your munis and everything, the interest gets added back into this, plus half of your Social Security benefits. So when you calculate out your combined income, if you're single, if you're below the 25,000 limit, there's no tax. They're not. Your Social Security benefits are not taxed. If you're between 25,000 and 34,000, you pay. 50% of your benefits are taxed as ordinary income, and above 34,000 combined income, 85% of your benefits are taxed as ordinary income. That can bump up your taxable income fairly quickly. For married couples, the same thing applies, but the numbers are a little bit higher. These numbers are fairly low, and the one thing of interest is that, to the best of my knowledge, they're not in any way indexed. These numbers, I think, are the same today as they were 3 or 4 years ago. So I assume it's not indexed, which is a little bit strange. Well, it's to the Washington's advantage not to index them, I guess, so I shouldn't be surprised.
What happens if you are retirement age, but you are still working? What happens to the benefit
If
after
you've
retirement?
reached your full retirement age and you're working, you can still get your full retirement benefits without any loss. And if you need it for cash flow reasons, you may need to do it. But if you're actually continuing to work and you can live on the salary that you're getting, you should probably consider deferring the benefits beyond full retirement age, maybe all the way out to age 70. Now, one of the questions that had been asked earlier is whether it's worthwhile to tap into your retirement portfolio during between full retirement age and age 70 in order to get the increased benefits. It's not a clear-cut answer. It's the typical financial planning weasel words. It depends. If the economy is doing great, if the stock market's doing great, it may in fact be worth tapping into that for 2, 3, 4 years, however long you want to defer taking your Social Security benefits to get the extra 8% per annum. Plus, it's not just 8% per annum. You get the 8% per annum plus the COLA gets added onto that. So it's actually a fairly decent return you get on that investment. On the other hand, if the stock market is not doing well, or if you're in the middle of a bear market, you really do not want to go pulling money out of your retirement portfolio under those conditions. You can permanently deplete your retirement portfolio pretty badly doing that. So you would probably want to forfeit the opportunity to delay taking your Social Security benefits.
Fred, this is Susan. I'd like to go back and look at another model on using retired assets or retired assets you should save for retirements in order to delay taking Social Security until age 70. The prior example I had mentioned about, and I think it's a good point. If the market's strong between your FRA and age 70, and it might make sense to go and pull money out. If it's weak, then you might have to look at plan B.
Yeah.
But what if you've got a bunch of cash sitting in a taxable 401k? And so let's say I go and get that cash, and that cash would be taxed as ordinary income, versus if I pulled it out of, let's say, a capital gain, which is roughly taxed at 15%. But could I, between my FRA and age 70, go out and pull cash to help fund my expenses, basically my cash flow between the FRA and to age 70? And if so, what would the taxation be? I think it's ordinary income.
It will be ordinary income. The answer is technically yes, you can do that, but I would have to question why you had a bunch of cash sitting in that account in the first place, it's probably to cover, an emergency fund. And if you're digging into your emergency fund to do this, then I might have some reservations about it. I guess it comes down to the simple question as to why you had the cash sitting there in the first place.
Sure, I can answer that if you'd like.
Well, I mean,
Yeah.
I don't need to know the answer, but
Yeah.
I think you do before you make the decision.
Right. Yeah. Okay.
If you no longer have that need, then and if the choice is between investing the cash back into the market or investing the cash into buying this annuity, because that's really what you're doing when you elect to defer your payments. You're really buying an annuity, funding an annuity, and you have to look at both of those investments, as it were, and see which one makes sense to you.
Okay.
Okay, this is again is something we've discussed before. If you've actually filed to delay taking benefits to age 70 because you want to maximize your benefits, but the world hasn't been nice to you. Things have changed since then. Let's just say, for example, that maybe you desperately need the money now, maybe for a medical emergency or any other reason, doesn't matter why. Or the other possibility might be that both you and your spouse have been diagnosed in poor health unexpectedly. And these kind of things may make you want to reconsider the decision that you made earlier, and that it no longer looks like a good decision to defer. What can you do? You only have a limited opportunity to backdate an application to the month of your full retirement age or to 6 months, whichever is the shorter. And if you do that, you can, to either of those limits or whichever limit applies, you can collect the lump sum benefits that you had elected not to do in your primary filing. But it's not a huge amount. The maximum is going to be 6 months. But if you really need the cash, it's something that some people may need to consider. Now, what happens going the other way? Supposing you had actually filed earlier, or you want to get your some cash back. If you file to get your benefits early and you want to get the cash back, if you change your mind within 12 months of claiming the benefits, you can actually pay back all the payments that you received and restart your benefit calendar at the higher rate. I mean, it's going to be tough to say, I've gotten all these checks from Social Security, I put them in the bank, hopefully I haven't spent them all, but if I really elect to, I can write a check back to the Social Security office and say, sorry, I really didn't want to do that, that was a mistake. Here, take all your money back, and can you reset me as not having filed yet? You only get to do that once. The other option you have is that if you wait until full retirement age, you can at that point go to the Social Security office and say, okay, I had filed to take my benefits early, and that's a done deal, but I now want to change my mind on that. So going forward, I want to suspend future benefits for the time being, maybe all the way out to age 70, so I can get my 8% per annum on that. And if you're doing that, you don't have to return any money to the Social Security office. But obviously, since you've been collecting benefits already from age, say, 62 up to 66 or whatever your full retirement age is, that will already have reduced the PIA that you get, the primary insurance amount and the payments, the monthly benefits that you get. So even if you wait until age 70, it's just that the reduced benefits can at least be bumped up at 8% per annum between age 66 and age 70. So you do have that option as well without having to pay back everything.
Does that mean you can't suspend before your full retirement age?
You can't suspend. No, I
The way
don't,
this,
this is the special case where you've already elected to take benefits early and changed your mind on it, and then said at full retirement age from here on going forward, I only want to I want to defer from here on. It doesn't affect the case where you've not filed at all, not filed early. You can still suspend. If you've not filed to start early, if you've elected not to do that, then you can obviously suspend at any time you like up to full retirement age. Was that what you were talking about, Deborah?
it was just the way this was phrased. It sounded like if you filed early, you couldn't suspend before your full retirement age.
Oh, you mean before it? You can suspend before full retirement age, but if you do it before full retirement age, you have to make restitution on the benefits you've received so far.
So you have to, even if you're just suspending from this point forward.
That's correct.
That's interesting.
If you have to wait until your full retirement age if you do not want to have to refund the dollars you've received so far.
Question,
Yes.
what's the advantage of suspending?
You mean in case?
So I'm at age 62. I'm at age 62, say, and I file and suspend immediately. What's the advantage of that?
Oh, if you file and suspend immediately, that would be the same thing as not filing at all. And Deborah and I were talking about this earlier as to whether or not it gives you any benefit. I don't know the answer. It used to be that if you filed and suspended early, you kept open the option later to undo it.
The suspending.
To undo it all the way back. But I don't think that that's the case still. So that benefit has probably gone away. I don't honestly know the answer to it.
Okay.
There used to be a benefit. I think the benefit has gone.
That question?
Yes.
To get the full benefit at age 70, they can file at 70 or before 70 at FRA?
To get the full benefit to age 70.
At what age we should file?
Well, the simple thing is not to claim any benefits at all. Just don't even talk to the Social Security office until you reach age 70 and then file.
Okay.
But that's one way of doing it.
Okay,
But
thanks.
what Charles was talking about and what I'm not clear on is whether there's any benefit to saying earlier, say at full retirement age, proactively saying, I don't intend to touch this until age 70, please suspend all benefits.
Yeah, and this is Holly the cynic speaking again. And the only reason I can think of to file and suspend if you really don't want to claim until you're 70 is fear of some political phenomenon that grandfathers people who are already receiving or have filed for Social Security, and there's no way to predict that. But in my cynical mind, that's the only reason you would do it if you didn't need the money before 70.
Yeah, I think you're right. Most people basically just wait. But if you want to proactively go on the record for any reason, I guess you can do it that way.
There used to be an option where if you filed and suspended, then if 2 years from now you got sick, you could choose to take your benefits at that rate or take all the back pay at that rate. But from what Fred is saying, that option is gone.
I don't know for certain that it's gone, but I think it has. That was one of the big benefits to filing and suspending, yes. And a number of those loopholes got closed off over the last couple of years. Okay, let us move onward.
Well, Fred, I just want to say that this has been so interesting and valuable to me. And I am going to create a dating profile tomorrow saying, if you can put up with me for 10 years, my Social Security benefits are XYZ per month. Yay!
Well, people, like I said right up front, people tend to underestimate the complexity of this. And granted, it's not quite as complex as it was 5 years ago. 5 years ago, it took a lot of computer power to crank out optimum results because there were literally hundreds, maybe thousands of possibilities to try to search and find the optimum strategy for couples. And there are a number of folks that were peddling expensive software to do just that. Now, it has simplified a little bit in the meantime, but there are still some crazy options that may make sense for some people. Okay, are we ready to move off Social Security and switch over to Medicare? Are there any final issues on Social Security? Okay, upward and onward. Medicare is 1965, Lyndon Johnson, and most folks are familiar with the part A, B, C, and D. A is the major medical and hospitalization. B, doctor visits, outpatient care, medical equipment, et cetera. Part C are the Medicare Advantage plans. They're mostly PPOs. There used to be HMOs, but I don't think there are any anymore. I'm not sure why. And that most of the Advantage plans include vision and dental benefits along with drugs. Part D is prescription drugs. Yes?
I'm sorry, and I may be wrong about this, but I just recently was looking at some of these Medicare Advantage plans, and a lot of them are HMOs and not PPOs. Like Kaiser, you're restricted to. I mean, they're HMO.
Well, can you go outside the network?
No, you can't. There's a coalition that.
Yeah, no, I'm sorry. Maybe I'm not being clear. Yeah, they're all. First of all, it's hard to make a blanket statement because each county has different rules, and some have, and they have different options and so on. But almost all the Medicare Advantage plans I've seen to date, currently, require you to stay within network unless it's a genuine emergency, a real emergency.
Yes, absolutely.
Okay, let's get on to the fine print here. What I've done is look at traditional Medicare and the Medicare Advantage plans and the pros and cons of each. I'm not sure if it makes sense. Well, let me go through it real quickly now. For the traditional Medicare, obviously the federal government is the insurer of choice. For the Advantage plans, you've got a private insurance. You're talking about Kaiser or Stanford or any Blue Cross, any of these. There's a difference in philosophy. The traditional Medicare is basically fee for service, whereas the Medicare Advantage ones are almost all, to the best of my knowledge, a managed care model. The care provider, in the case of traditional Medicare, I love this part of it. Any doctor who accepts Medicare, that just sounds great until you run into the roadblock that says not all doctors accept Medicare, and you may find that your doctor doesn't. So if you're considering going this way, you need to check with your current doctor or doctors as to whether they accept Medicare. With the Advantage plan, you stay within the network. Deductibles apply in both cases. Co-insurance, most of the traditional Medicare is a 20% co-insurance, none typically in the Advantage plans. Annual out-of-pocket limit, no out-of-pocket limit on traditional Medicare, so that can get into some pretty serious high dollar numbers if you truly run into some major issues. Most of or probably all of the Medicare Advantage plans do have an out-of-pocket limit, typically of the order of a few $1,000s, $5,000, $6,000, $7,000, something like that. Do you need to get a referral from a specialist, or need to get a referral from your primary doctor to see a specialist? For traditional Medicare, no, but very clearly yes for the Advantage plans. Drug coverage, vision and dental coverage only come with separate Medigap policy, supplemental policies if you have Medicare. Medicare, the traditional Medicare stuff does not cover drugs or vision or dental or any of this stuff. You need a separate policy. The Advantage plan usually covers, well, it almost certainly covers the drugs and usually covers vision and dental as well. Outside of the US, traditional Medicare, forget it, it doesn't apply. Most of the Medicare Advantage plans have some coverage if you're traveling. The other crazy thing is that if you're on traditional Medicare, you're typically going to be carrying 3 insurance cards with you. You have your Medicare card that you keep in your wallet, plus the supplemental insurance, the Medigap insurance card, and plus your drug card, 3 separate cards that you have to carry around. With the Medicare Advantage, you got the one card that you offer up in all cases. The final question here is, can you switch back and forth from one to the other? At the end of each year, there's a time period allocated where you can make a switch one way or the other. You have to, it's a fairly complicated analysis as to which plan is optimum for you. And unfortunately, you got to go through that whole workout every year to see if the plan you chose last year is still the best for the coming year. And in order to do it properly, you frankly need a spreadsheet with at least three different sheets. You need to look at, here's my typical anticipated medical needs for the next year, and here's a best case, and here's a worst case. And if you do the analysis for those 3 things, you may come up with a different answer as to which the optimum plan might look like. But to switch plans, if you want to go from traditional Medicare over to Medicare Advantage, it's very, very easy to do that. But if, on the other hand, you have a Medicare Advantage plan already or in prior years, and for some reason you want to switch back to traditional Medicare, it's possible to do it, but, and the but is the insurance, the Medigap supplemental policies don't have to accept you. It depends, you may have to qualify for it. If when you first are eligible for Medicare and you want to get a Medigap policy, they have to give it to you for that one window. But once and it's at a competitive rate. But once that window is closed and you've elected at some point to switch over to Medicare Advantage, if you want to go back, the supplemental plans are allowed to qualify you on your current health, and you may not qualify, and even if you do qualify, all bets are off on the premium. So it may be a little tricky going back. It's not impossible, and but you may have to do a fair amount of work to search out the optimum provider for the Medigap policy. Anything there that anybody wants to comment on?
Sure. Fred, this is Susan. So do you have a sense of, I guess I have 2 questions. Do you have a sense of kind of what a traditional, let's say, I'll just focus on Medigap, what Medigap it would be in the county of Santa Clara, or what a premium would be in Santa Clara, the county of Santa Clara or county of San Mateo?
Can you hold that for a minute, and I will show you why I can't give you an answer.
Oh, okay. Yeah. Okay. And let me ask you this. Why would one choose traditional over Advantage? And this is what I have heard, and I don't know because I'm currently still on private insurance, is that the Advantage premium is far less expensive.
No. Again, it depends. It depends on how sick you're going to be next year. And that's what complicates the heck out of it.
Okay, we'll let you answer that later on.
One of the questions you ask yourself if you're considering traditional Medicare, the very first thing you should probably do is call your current doctor and ask if they accept Medicare, and also any specialists that you've seen, see if they accept Medicare. If they don't accept Medicare, then you may have to shop around and find somebody who does. And the problem, quite honestly, is that Medicare only pays the doctors a very meager amount. in order for Washington to balance their budget, they pay doctors 20, 30 cents on the dollar, and they pay it 6 to 9 months late. And a lot of doctors, especially doctors who've been in practice for some time, don't necessarily want the hassle of dealing with Medicare patients because it doesn't pay them to keep the lights on to do it. It doesn't cover their basic costs. So when traditional Medicare says you can go to any doctor, that's true within the limits, but you need to make sure that the doctor that you've chosen to go to will accept Medicare. But if they do, it may turn out to be cheaper. Again, it depends on how much you use it. If you get hit with a number of 20% co-insurances for big issues, that could drive up the cost. The Medicare Advantage has its own costs. In the early days, the Medicare Advantage was a $0 extra premium. If you go on the Medicare Advantage, you still must pay your Part B fee to Washington every month. And to be a Medicare Advantage, that has to be enforced. In the early days, the medical offices that were offering the Advantage plan did not charge anything additional. Currently, most of them charge anywhere between $50 a month up to maybe $150. I don't know, it depends. Some of them may even be a lot more than that for the privilege of joining their group. They will get reimbursed on a per patient basis from the government, but they may need an additional fee from you on top of that to make it worth their while being in business. Now, to be fair, most of them also offer additional items that you don't get under the Medicare Advantage, like the drug coverage, or some of them offer the vision and dental. So it's not easy comparing them. And it's something you got to do every year, theoretically. Now, even if you go with an Advantage plan, you need to compare the different Advantage plans every year because they all change.
Question?
Yes.
So if you're still working, are you forced to do Medicare, or you're allowed to keep the insurance you had with your work?
If you're still working, again, I'll cover in a minute, you will probably have what is known as a creditable plan, which means that you are exempt from joining the Medicare system. I'll get to that, Charles, in a little more detail in a minute.
And I presume, so the other question I had, which I hope you'll get to, is how does your wife or spouse work into collecting Medicare? It's just for you, and then you have to have a policy additionally for her if she's younger?
You're both separate, and you do your separate things.
Okay.
Usually. I'm not sure. Theoretically, some of the Medicare Advantage folks, I don't know, but you would think that they might be able to give you some sort of a cut, but I don't know of any.
Okay.
In practice, you both do your own separate things. You don't have to both be on the same plan by any means. Okay, so we're going to cover some of the Medicare myths. We've got 7 myths, and some of them are obvious, but some of them are not. First one is, I can sign up anytime, there's no rush. Well, you'd better sign up within the 7-month window. The window is on your 65th birthday, plus or the month of your 65th birthday, plus or minus 3 months. And that's regardless of when your full retirement age, regardless of when you elected to take Social Security early or late or in between. That 65th birthday, plus or minus 3 months, is a window, and you really need to sign up within that window, preferably at the front end of it, just so that if anything delays or if there are any snags, you reach them early. If you don't do that, there's what I consider a draconian penalty on what you pay for the Part B coverage. And the penalty, once it's in there, never ever goes away. The penalty is 10% additional premium for every year that you were late in signing up. So if you made the argument that at age 65, well, I'm in pretty good health now, I'm going to wing it for a year or two, I don't need it, you could be paying a big penalty for the rest of your life. 4-year delay will hit you with a 40% penalty. The one thing, and this is what you were asking about earlier, Charles, the penalty does not apply if you can prove that you have a creditable plan. That's their term, not mine. What it really means, you have to prove that you're working or that you're covered by a plan that gives you the same or better coverage than Medicare, probably because you're working and it's your employer's plan, but it doesn't have to be. So if you can prove that you have a creditable plan already, then you can elect not to sign up in that 7-month window. I would suggest what I suggest to most folks is that even if you are still working, that you go to your HR department and ask them for a letter showing you that proving to you that you do have a creditable plan as defined by Medicare, and you take a copy of that into the Social Security office and let them know what you're doing. Because if there are any snags, you would rather discuss it with them now rather than 3 or 4 years later when there are big, big dollars on the line as to whether you get the right decision or not.
If I may jump in on this, I was employed when I was 65, and I was warned actually by my sister, who spent a career in insurance, retired with that, and sure enough, it happened to me. Employers want to shift you to Medicare. They know when something flags them when you turn 65, and I sure enough got a letter saying I need to be on Medicare so that Medicare will be my primary insurance, and the company's insurance will become the secondary insurance. So
that may well be the case. I think that may differ from employer to employer. But again, it reinforces what I've said. Talk to your employer and either get the letter or the reason why they won't give you a letter and work it out with the Social Security rather than assume that everything will be okay when you turn 70.
Well, that's why I'm jumping in now, because if you flag the employer, they're going to say, heck yes, we want you to be on Medicare. Then you may even flag it for them, and then they'll say, you better get on Medicare.
Well, no, I mean, trust me, the employer knows when your 65th birthday is, and they know when you would normally be signing up. So if they want you to sign up, they're not going to be shy about pushing you whether you come to their office or not.
That's correct. That's what they did to me.
But you need a very clear answer at that time. There's no, anything that's fuzzy at that time is going to be a real tough negotiation 3 or 4 years later if it hasn't been resolved. Because if you're talking about 10% per annum penalty for the rest of your life, that's big dollars.
You are exactly spot on. I actually had both Medicare while I was employed. So I had employer insurance and Medicare because I did not want to monkey around with the possibility of that lifetime 10% penalty.
Yeah.
Well, I'm with you.
And the same argument goes, as we'll see on myth number 2, for the drug plan. Again, folks tend to say, well, I'm not taking any prescription drugs now. Why should I buy a plan? But the same draconian or a slightly different draconian plan penalty applies here. It's 1% per month. So it's 48% for a 4-year delay. And again, if you can prove a creditable plan, you're okay. But if you can't, let's get it resolved right up front. And those are the reasons why I like to go at the beginning of the 7-month window, because this stuff can drag on and you want to get it all resolved cleanly. In fact, some folks would argue that you push the Social Security office for a letter saying that you've been in there and discussed this with them, and they accept that you're covered on a creditable plan. I'm not sure if they'll actually do that for you, but it doesn't hurt to ask. Well, I would love to have as much paperwork in my file as possible come my 70th birthday when I decide, okay, now I'm going to sign up. Any other questions on these 2 issues?
I thought insurance plans are required to send you the letter of credible coverage if they are. And when my husband signed up for Medicare, all I had to tell them was, we had the letters, but fortunately all we had to tell them was the company that covered him, and Medicare went back and got the record so that there was no penalty.
I'm not familiar with that. You may well be right, Deborah. You've played in this area a lot more than I have, so you're probably right.
Is
So,
there any,
Martha,
ahead.
you sent a big long text that I can't read through. Do you want to describe what you're saying live? Fred to Martha. Is anybody out there? Oh, maybe. Okay, no, Mike. Okay, I'm sorry. Well, let me
I have a question.
real quickly.
Fred, this is Susan. Did somebody else have a question?
Oh, I do. This is
Okay.
Sylvia.
Okay.
But go ahead and answer that one first.
I can read Martha's question if you want.
Yeah, why did you phrase it for? Because I don't want to shut everything down here for.
So she says, in my opinion, Medicare Advantage versus Medicare is a stylistic difference, mainly re-choices of doctors versus getting bills. HMOs have a built-in conflict of interest since they are both the provider and the insurer, so their self-interest is keeping the costs down. Unfortunately, Kaiser sees that as an identical to keeping their member population healthy. With Medicare and individual doctors, their self-interest is to maximize their income, hence the risk of too many procedures and tests. But you do get to choose your doctor without network concerns. It's a wash, in my opinion.
Yeah,
That's what she said.
It's not an easy decision. If you have a good doctor that you've been with for a number of years, and if that doctor accepts Medicare, there's a strong incentive to stick with that doctor on the traditional Medicare. If that's not the case, then you may want to consider, if you're looking at switching doctors anyway, you may want to consider one of the Advantage plans. In the Bay Area here, the Advantage plans are mostly, I guess, Stanford, Palo Alto Medical Foundation, and Kaiser. So if you look at those three, that probably covers most of what's available. The County of Santa Clara has a limit on the number of plans. If you're in Santa Cruz, you may have different plans. Okay.
Is there?
Right, so this is fine as long as you're going to stay in the county and be served by those providers, right? But if you're looking to travel or retire overseas, I don't know. I just feel like it's too complicated to really address all the issues in this. And, frankly, looking at their plans and all the details and the fine print, that's essential.
It's not trivial. Absolutely. It just blows my mind how complicated these decisions are. And I really weep for the folks who are bagging groceries in Safeway trying to make this decision. Okay.
I have a question.
Yeah.
So is there any other qualifications that you need to have for Medicare and Medicare Advantage? And also, does pre-existing conditions, how is that factored in?
Oh, for Medicare, when you first sign up, the pre-existing condition should not be an issue. I'm not sure what other qualifications you might mean.
Like, do you have to have certain level of health to qualify, or any other qualifications?
No. For
Advantage? For the Advantage?
Oh, for the Advantage, no, I don't believe that they have pre-existing. Well, I'm going to soft pedal that a little bit because I'm not absolutely clear. It depends on some of the changes that have been coming out of Washington recently, and what's pre-existing and what isn't, and what's covered and what isn't. I'd rather not give you a firm answer because I just don't know.
So do you have the premium? Like, how much will it be for Medicare, and how much would it be for Medicare?
I will give you the premium for Medicare in a minute when we're doing that. Well, right up front, I can tell you now that the premium for Medicare Advantage plans, you must pay the Medicare premium first, And then on top of that, you probably have to pay anywhere from $50 a month extra up to maybe 100 or 150 extra. It used to be that the Medicare Advantage were zero additional extra, but I guess their costs have gone up mostly because they've been adding additional features in. So a typical, well, I know for Stanford, for example, I happen to be with Stanford, they charge, after I pay my Medicare fees directly to Medicare, Stanford charges me $100 a month for their, I don't know, silver plan or whatever they call it, and 120 for their gold plan, which includes the dental and vision. Those are the ballpark numbers. I suspect you'll find that PAF, Palo Alto Medical Foundation, and Kaiser probably aren't too different. They're all somewhat competitive.
Fred, this is Susan. I just have a quick question. If I go Medicare Advantage and it doesn't have a drug plan, then I should be signing up for Part D.
Yes. No, I don't know. You can't sign up for Part D. Oh no, it won't be a Medicare, but you will need a drug plan one way or the other. Yes.
Right.
But almost all of the Advantage plans include drugs.
They do. Yeah. Okay.
I don't know of any that doesn't. Theoretically, they don't have to, I think, but almost all of them do, even if it's just to be competitive.
Right. So your slide 24, where you show, signing up for Part D, that assumes you are signing up once again the month of your 25th birthday plus or minus 3 months, and that assumes that you're going with traditional Medicare.
Yes. Yeah.
Okay. Thank you.
Oh, I remember now. So if you don't have any assets, so you don't need to get supplement B for Medicare, or you automatically get a white card or something like that?
I have no idea what, I don't know
You're
anything about
talking Medicaid?
Oh, that's Medicaid. Okay.
That's Medicaid. You normally have Part A and Medicaid, and you have to worry about how they interact, which is a completely new can of worms, a much larger one.
Yes, yes.
So how do you know when you get Medicare and when do you get Medicaid?
I think it depends on your income.
Mm.
You can have both. Medicaid depends on income. Medicare depends on your age and if you've paid into the system.
Oh, okay.
Medicaid depends on income or assets?
It can depend on
I
both.
don't think
Both.
it's assets.
Yeah, you
It
can't have
does.
any assets.
So you could have $10 million and you can get Medicaid?
Yes.
No.
Oh, no, I'm sorry. You can get Medicare, not Medicaid. No.
Right. Medicaid is if you're destitute.
You will be income tested.
Right. But you're also asset tested. You have to have
Income
nothing.
and asset, yes.
Right.
Yeah.
Okay.
But for Medicare, that doesn't apply because they're tagging you fairly hefty premiums anyway.
So if you have Medicaid, you automatically get Medicare?
You're into a completely new round of issues. Medicare, if you've paid into the system and you're 65, Part A is free. Depending on your age, on when you become disabled, we're into this with my brother-in-law with his being special needs, and where there's disability, things get very messy. It is to say the least, a presentation of its own. So, and there are some plans that claim to be dual complete in that they coordinate your Medicare and Medicaid benefits.
Sylvia, I think you're beyond the scope of what we're qualified to talk about.
Okay, okay, that's fine. I'm just curious.
I would seriously suggest that you talk to a professional.
No, I'm just curious. That's not my case, but I'm not even near the age to. I wish I could retire. I can't retire right now. That's my problem. Is that if I retire now, I won't have any medical insurance, or it will cost me a lot of money, so I can't retire.
You're right, it would cost you a lot of money, yes. and you're right to consider that seriously before you pull the plug on a job. Yes, that's one. It could cost you easily $15,000 a year. You could be paying 1,200-1,500 a month very, very easily
Wow.
if you're not careful.
Yeah, the ACA, I don't forgot what they call the supplemental payments, is based on income, and you can look at whether or not you would get. You have to have enough income, but not too much income to get the payments.
The insurance companies have all the data and it's all stacked against you. Sorry. Okay, I'm going to move on a little bit here. That's okay with everybody.
Fred, and you call me a cynic.
There's
I know.
there's one comment on the Part D penalty. It's based on their average plan, not the plan you take. So if you've got a high cost Part D plan, it might not be the full percentage of the plan you've chosen.
Yeah, the average is likely to be lower than what you'll actually pay in this part of the world. It may not be quite as bad as you think, but on the other hand, you really don't want to find out the hard way.
That is very true.
Here on the text, which basically says that her father neglected to sign up for Part D drugs and was so sorry ever since. It's you might think when you're 65 that you're in great health and you're going to live forever, but boy, things can change very quickly. Okay, myth number 3. I've been paying into Medicare all my working life, so there's no charge now. Part A is free insofar as it's funded by the government, but Part B you pay for, and it's currently, when I first retired, I guess this was 15 years ago, or just before it, Part B was a nominal sum. I think it was $35 a month or something, so I totally discounted it. But a couple of things have happened since then. Number one, inflation has bumped it way up to $144.60 a month now, for this year. And on top of that, there's an IRMA involved, which is income-related. It's an additional income-related monthly adjustment amount, IRMAA, for both Parts B and D. And what they're really doing is income testing. They go back to your old 2-year-old 1040 return and look at the AGI on that, and add back in the tax-exempt interest from your munis. And that gives you your MAGI. And once your MAGI is above a limit, which I'm going to discuss in a minute, then you pay an extra amount. Is there a way of means testing the Part B premium? But the $144.60 a month is just a starting offer from them. Here's what it can turn into very quickly. For single filers below 87,000, there is no IRMA, and for married filing jointly before 174,000 MAGI, there is no IRMA. But once you cross those limits, it goes up very, very rapidly. And if you go to the other extreme, for anybody that has an MAGI above $500,000 or above 750,000 for the married filing jointly, you can pay as much as $347 for extra for Part B, plus the $76.40 extra for Part D, over and beyond the, what did I say it was, $144.60 for the standard. So you can be up around $6,000 or $7,000 very easily on this. Now, I don't expect too much sympathy for those folks who are up in this higher tax bracket, but anybody that is covered under what I call the curse of the working spouse may well be there. For folks who have retired or think that they are retired but the spouse still works, you can be paying a much higher Part B and Part D premium than you might have planned when you're putting together your own retirement plan, a decade or two ago. it can get expensive very quickly. Any comments?
Question?
Yes.
The modified adjusted gross income, does that also include dividends added back if you're like at 0%?
I think they're actually, I mean, they literally go to your, for this calendar year, they're going to go back to your 2018 tax return, because that's the last full return that they have. You may not have filed your 2019 yet. They will actually look at whatever line your AGI shows up on that, and whatever's on there, they also look at the line a few lines above that, which talks about the tax-exempt interest or non-taxable interest, mostly from munis, but there may be some other issues, I guess. Those are the only two things that I know of that get added into your MAGI. If you're already retired or paying into your social or into your Medicare, you will presumably get a letter every year. I think it normally comes, I'm not sure, November, December, maybe as late as, well, probably November, December, telling you what the limits are for your standard payment, and the $144.60 goes up every month or every year. It's adjusted for inflation, and it also gives the tax brackets that I've shown here for the IRMA. So it gives you all you need to work it out, but it's painful. And the other thing that's even worse is that when we were talking about Social Security, we talked about the COLAs, the cost of living allowances. Social Security is adjusted every year for COLA, but there will be some years, and there have been the last after 3 or 4, the COLA has been 0. For this year, for 2020, I think the cost of living allowance was 1.6%. But you may well find that whatever adjustment you get up for the Social Security, Medicare takes that out and more sometimes for their increase. So occasionally it happens, and it has happened in practice a couple of times in the last 5 years, that the actual Social Security check that you get net of Medicare, because the Medicare payments get taken out of it, goes down the next year. The Medicare costs have bumped up more than the bump up you get in the Social Security. It's a little bit of a bummer when Social Security tells you that there's 0 COLA because there was no inflation last year. You say, well, try explaining that to the Medicare guys. They're not listening.
Question?
Yes.
So if you started Medicare at 65 and you had one of these additions, the IRMAA, and then a couple years go by, does it get recalculated based on your income 2 years back, or are you kind of stuck at that level forever?
No. It gets calculated from scratch each year. Each year they go back 2 years in your tax return. Like I said, for 2020, they're actually looking at your 2018 return. Next year, they're going to look at your 2019 return. And one of the things that comes up here is that if you have some extraordinary expense, maybe you sold a bunch of Apple stock that was doing great, and you got your AGI bumped way up. 2 years later, look for a bump up in your Medicare Part B and Part D payments, and if it goes back down again, it adjusts year to year. There are also mitigating circumstances that you can file if something has occurred that's a little extraordinary, that bumps up your AGI, and you think it's unfair to have Medicare use that higher number, you can appeal it, and there's some circumstances where they will listen to you. I think, Deborah, do you want to comment on that? I think you've had some issues
Yeah,
where you were
when I
successful in
retired,
appealing.
I was able to drop it because my husband was already on Medicare, and my retirement, and it would have also been his retirement if that happened. You can request review, but things they don't want, but it's things that, other things that are under your control, they won't consider, like selling stock. And they normally specifically list selling your house, though some recommend you try and ask anyway for that.
Don't count on it, but it may be worth a try.
When you say
Yeah.
ask, does that mean filing some paperwork?
Yes.
Yes.
I took in my, when I
There's a special
retired,
form you have to sign.
I took in my last paycheck with the termination paperwork and did their form, and that went through fine. As I said, for that, they specifically list that selling a house is not an option, but others I have heard recommend it, that occasionally it works even if you, even though they say it shouldn't.
So as a general
If
rule,
you
you
can
should,
argue that you have to sell, if you can argue that you have to sell for some legitimate reason and it wasn't just a voluntary sale, you may be able to convince them.
as a
It's worth a
general
try.
rule, you should go into the office for this. You don't mail it in and just hope they figure it out.
I went in because I made an appointment, but you can do it. You can mail it in. That's not a problem.
By the way, I have found my personal experience with the Social Security office on Hamilton and Campbell, that when you go in and take a number, you think, oh my God, I'm going to be here for the rest of the day. If you have an appointment, I found that it actually worked in practice pretty well. And the person I got to speak to was actually reasonably smart and cooperative. It's a little different to the DMV, I think.
And the key point is, if you have an appointment, it goes well.
Well, let me be the contrarian here. I tried generally speaking, my experience at Social Security office has been positive. Been there several times. They're all have pretty good attitudes and are trying to be helpful. Although the answers are not always consistent. My experience with the 800 number was much better. And the one time I called the 800 number to make an appointment, I was told at the office, make an appointment. I did it on the 800 number, and she gave me an appointment 2 months out. So we're both laughing about that. She said, just go down there to the office. So making an appointment was kind of pointless. The other comment I would make, and what the reason for several visits, was they were charging me an IRMA for Part B because they thought I was still employed. And I thought somewhere when I applied for Social Security, it came up in the conversation, I'm not employed anymore. Don't make that assumption. And I think somebody mentioned that they had some paperwork to prove it. I had to submit a form and made copies of my termination notice. And they actually did two things. They stopped the IRMA and they also refunded me, actually partially, it's a bit of a long story, for what they overcharged me, the IRMA that they charged me for. The lesson I learned was, don't assume that they know you're not working and that you don't have a job and income from that job.
Yeah, you have to specifically apply for the removal of the IRMA. They will not do it automatically.
That is correct.
What's
But if
IRMA
you
stand
think you have
for?
a halfway decent case, make it.
So the IRMA for a particular year, you have to file a renew, but then every year they recalculate. Is that correct?
Yes.
From scratch. Yes.
What is IRMA stand for?
IRMA stands for, here we go, Income Related Monthly Adjustment Amount.
Thanks.
It's the additional payment over, it's the additional means tested payment over and beyond the standard charge for Medicare. Okay, moving right along.
It's the success
Myth
tax.
number 4. I beg your pardon?
It's the success tax.
Absolutely.
Oh, yes, yeah, I guess. So it's hard to have too much sympathy or to expect too much sympathy for being successful, but it still hurts. It really makes me feel that I was sandbagged for 40 years of work where I was paying into the system thinking that Medicare was going to cover all my costs when I retired, and then suddenly find myself being tagged with all of these additional costs, significant costs. Okay, myth number 4. Now that I've signed up, most of my medical costs are covered. The heck they are. There are traditional Medicare has fairly significant deductions and the 20% co-payment. So there's a bunch of fairly heavy duty per visit costs that come up. Most people, and there are big gaps in their coverage and limits on how long some of the coverage lasts for. So most people find it prudent to buy a supplemental insurance plan from a private insurer. That's the Medigap plan. And as we discussed earlier, if you buy this at the time that you're first eligible to sign up for Medicare, the private insurers have no choice but to accept you. It's not in any way underwritten. But if you come back to them a year or two later and say, I didn't want it back then, but I reconsidered and now I want back in, then they can qualify you by checking on your health, and there may be reasons why they either reject you or they may just bump the premium up. You may not get the policy that you want all that easily.
Okay, so does this go back to the idea of if you've got pre-existing conditions, you might be in trouble if you don't sign up right away? Or if
it absolutely does, Holly, because if you're with a Medicare Advantage plan and you want to go back into traditional Medicare will take you, but you may not get a Medigap supplemental policy because of the pre-existing conditions. And you're going to see as we get deeper into this, you really need in practice a Medigap policy. The holes in the straight traditional Medicare are big enough to drive a truck through, and you're leaving yourself wide open if you don't buy the additional supplemental insurance. So if they said that they're not willing to do it, you don't want to go there. So unless you're covered by a Part C Advantage plan, you almost certainly will need a supplemental plan. If you have Part C Advantage, you don't. In fact, you can't get a supplemental plan. If you buy a supplemental plan, I think it invalidates your Part C plan. They're incompatible. But okay, assuming that you want a Part C, that you want a Medigap policy, there are a whole range of different types of things that they cover. Mostly the gaps in traditional Medicare, which would be the deductibles and the co-payments. It also covers things like how long the hospital stays will be covered and that kind of stuff. But they have, how many here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 different plans with various levels of coverage of things that are covered and things that are not covered. And they are all standardized. Every insurance company that's offering a Medigap policy will, if they're offering something that looks like like a policy A here, which would be probably the minimum amount of extra insurance, it has to be the same. It has to be the same as everybody else's policy A, and the same thing for all of the others. But the policies are standardized, but the premiums are not. So you have to shop around. If you decide that you want a certain amount of coverage that's for example covered by Plan G, all Plan Gs will be the same, but you want to call around and see what the premiums are from the various insurance companies. Just in looking at these, Plan F, I think, was and perhaps still is the most coverage. It covers just about everything, but it's the most expensive. Plan F, I think may have been discontinued this year, except that it's grandfathered in, I think, for folks who've had it in the past and still want to continue it. It covers almost all of the gaps in traditional Medicare, but it's expensive. It used to be in the region of 150 or 160 bucks or something per month. So it's a sizable chunk of change. F-Star, again, I'm not sure if that exists or not, was a high deductible version of Plan F. It covered everything, but with something like a $20,000 co-payment or deductible. In other words, you don't get any coverage. You pick up the first 20,000 bucks yourself, but that drops the 150 bucks a month way, way down to minimum amount. But again, you need to look at all of these plans and see which cover what you want and what you don't. And one of the things we're going to discuss in a minute, for example, is that some of them cover foreign travel and some don't. Some cover the additional hospitalization days and some don't. Some cover, the deductibles better than others. So you got to take the time and trouble to go through them. You'll find that as soon as you become eligible for Medicare, that folks like AARP will deluge you with literature on this and copies of their ABCD plans and all of that, along with the amounts and the forms to sign up. And it's a lot of heavy duty reading.
Sure. Fred, hi, this is Susan. Do you know if regarding using HSA monies, can that be used to pay premiums, Part B or Part D?
No. Well,
or is it just?
I'm going to hit that very, very heavily
Okay.
in a minute.
Okay, fine. Thank you.
Don't even think it. Do not think it. Okay. So we've covered this one. Myth number 5, covered by Medicare wherever I go. No, when you go outside the U.S., you're not covered at all. Zero, zip, nada, zilch, whatever you like. If you want to be covered outside the U.S., if you travel, do a fair amount of traveling, you can most of the Advantage plans cover you outside the U.S., but if you have traditional Medicare, you're going to need a Medicap plan, and I've listed here the plans that I believe cover foreign travel. The other ones do not. Or you can obviously buy separate travel insurance. But don't think that you've got Medicare, so you're okay when you go to French West Africa. You're not. Medicare, a lot of folks, and this scares the heck out of me, a lot of folks think that Medicare covers long-term care needs. It covers you for 90 days after hospitalization, and as long as you can demonstrate that you're making progress. And on day 91, it stops. So it's not really long-term care in the normal sense. I mean, long-term care, most people think of needing it for 2, 3, or 5 years if you have dementia problems, or if you have problems, that you're incapable of taking care of yourself, not just after a few days in hospital. In essence, you really need to think of Medicare as having no long-term care coverage, because it's so trivial that's not even be worth talking about. So I'd highly suggest looking into the purchase of a separate long-term care policy, because this is one of what I have 2 or 3 traditional train wrecks that I talk about. All people have listened to me before have heard me discuss that ad nauseum. Long-term care is one of them. If you have a need for long-term care and you are not covered by any insurance, you have a train wreck on your hands, because it can totally wipe out the best retirement plan that you put in place over decades and thought you'd funded over decades, and suddenly it's all for naught if you have a long-term care problem and no coverage for it. Okay, that's myth number 6. Myth number 7. Here's where we're talking about the HSA. Was that Holly that was talking about that before?
No, it was Susan.
Oh, Susan again. Okay. HSAs are, I think, great retirement vehicles, because your contributions to it are deductible. The earnings are tax-free, so it looks just like an IRA, a traditional IRA, except it's even better, because it suddenly turns and looks like a Roth IRA when you're pulling money out. It's not taxed as long as it's for medical expenses. So it's a great vehicle that a lot of folks fund almost like an IRA and don't bother taking the cash out of it while they're still working and can afford not to need it, but just leave the cash in there for after you retire and then use it to fund retirement on a seriously tax advantaged basis. But in order to be eligible for an HSA, you must own a high deductible health insurance plan and not be on Medicare. The day you sign up for Medicare pulls the plug on your ability to contribute to an HSA. You
Question?
can still withdraw from it, but you better have it fully funded before you sign up for Medicare.
Question?
Yes.
So it's signing up. I was under the impression it was age 65. It's signing up for Medicare is the trigger?
Oh, it's the same thing. Medicare will become effective on the first of the month in which you turn 65, regardless of what you've done with your Social Security election.
So if I work till 70 and I'm still on my employer's plan, and I would still have to stop the HSA contributions at 65, right?
Good question. I'm not sure I know the answer. If you're working to age 70, I suspect technically, and again, you probably want to check this with your HR department, you're probably officially on Medicare receiving Part A benefits for no dollars. And probably all you're deferring is the Part B. I'm not sure. I mean, I don't know how they legally handle this.
That depends
but-
on the company plan, because that wasn't true for the employer I work for. You did not have to apply for Medicare. So it's all depends on the employer plan.
Yeah, employers have a fair amount of flexibility in how they write their own. It must be obviously within the legal limits, but they can go way beyond that in some regards. The same thing goes obviously for your 401k plans.
So, Fred, this is Susan. Regarding HSAs, yes, I think in order to contribute to an HSA, you have to be in an HSA plan. But if one wants to use HSA dollars, and let's say I'm in Medicare Advantage and I've got a deductible I have to pay, can I use an HSA in that type of situation? HSA dollars to pay for that deductible?
I think probably yes.
Yeah.
I mean, the only constraint is that it be for medical expenses.
Right.
And if you're paying a deductible for an office visit, that to me is a medical expense, which should be a legitimate withdrawal from your HSA.
Yeah, that's what I understand. And I think also dental and vision might be also covered under HSA dollars, as can be legitimate
I believe so, yes.
Yeah.
Yeah.
I was
thought
under the
also-
impression also that if you can't use the HSA funds for insurance premiums before Medicare, but when you're on Medicare, you can.
I think for Part A, B, and D, but I'm not certain you can do it for any of the plans.
I suspect.
So before we retire, we have to
more
get,
questions
so
than we've
before we retire, we have to get a doctorate in Medicare to figure all this out, right?
I mean, around the table today, we've got a bunch of smart people. Pretty sure there's a pretty smart group online here now, and we're struggling to get it all under control, to understand it, and to find the optimum solutions. How does the rest of the world manage? Yeah,
Oh,
you're
You're going to have to watch your videos, Fred.
There's a lot of research and a lot of legal opinions involved.
I'll tell you my experience is both the wife and I went to multiple Medicare seminars conducted either by, say, Stanford or insurance brokers. And they're free, and they give you sometimes a little food or coffee or whatever, and just went to multiple. It's just really complicated. And
Yes.
you get to ask somebody, a professional, questions specifically to your situation. That's what I'd recommend.
I agree.
Yeah, no, so did I. Yep.
Isn't SourceWise a source of information on this subject? And that's available to everybody.
What was that,
Free.
Lynn?
SourceWise, won't they help people with this question? And that's a free.
Is that the group that we've had in talking to us before?
Yes.
Yes, I think they've changed their name and possibly to some extent their charter, but their mission is still to help people that make an appointment with them and come in for a one-on-one discussion, and also to run some seminars. And yes, absolutely, they're worth tapping into if you have questions.
Yeah, I talked to them last year because the prescription drug program doubled in cost and went down to their headquarters on Dela Cruz, something like that, and they were very useful, very helpful.
Can you give a name or a website or something that folks can go to
Yeah, I'll go grab the card. It's SourceWise is the name.
Okay.
Yeah, I think it was sourcewise.com. But he's going to go get their information, bring it back to you.
Okay. I think with long-term care policies and with annuity policies, another one that kind of falls into the same bracket, there are a lot of bad apples out there, and you do have to be careful. But if you're considering either of those, I think the first thing you have to check is the credit rating of who you're going with, because in both cases, it's absolutely imperative that they have a first-class rating so that they will be there to serve your needs 10, 15, 20 years from now, and not just next year. You need them to be around when you need them. So that's the first thing that you need to look at and not skimp. It certainly also helps to look at, I think, to go with a major company that has a name brand to protect, that won't screw you over in terms of bumping up premiums and so on. I agree with what Holly just said, in that a lot of the long-term care policies that were written 10, 15, 20 years ago underestimated the cost to the insurance company, and they got into serious trouble, and it triggered a whole host of mergers and everything because they just didn't have the data as to what the underwriter, what it takes to underwrite one of these policies. Most of that, I think, has been worked out now, and there are probably, well, first of all, there are a few companies that didn't make it, that got merged out of existence, which isn't the worst thing in the world because the policy should theoretically still be covered. But there's still 3 or 4 large reputable companies out there that are selling long-term care policies and that are selling annuity policies. And I think that both of them have a valid place in anybody's financial plan to at least consider covering both of those areas as a means of paying a third party to absorb some of the risk that you no longer feel comfortable taking on yourself or capable of taking on yourself. But you do have to do a lot of due diligence to make sure that you're not being ripped off and that you avoid the bad apples. No easy answer, sorry.
But how do you know what the bad apples are? You don't know the future.
They do not come with a little sticker that says rotten to the core. The credit ratings is one clue. There's folks that have researched the numbers on their balance sheets and all of that. But even there's some doubts that have been cast on whether the credit raters are totally above board themselves or are being paid off. It's tough to know.
So for Medicaid, I think they pay for long-term care, don't they?
I do not know.
Medicaid does, under some circumstances, pay for long-term care. It's not great long-term care, but there is coverage.
Yeah, Medicaid is the payer of last resort, I think is the way to look at it.
Yes, that is exactly how it's phrased.
You need to, in most cases, you have to spend down most every penny you have in your retirement account to qualify for it. There are some exceptions. They will let you own, I think they still let you own a home and let you own a car, but you're not going to have a big retirement account that you can dip into.
That is correct, Fred.
And I heard they look back too. If you
Yes.
like wanted to liquidate yourself 5 years previous or something, you have to
Yes.
be sure you do it right, or they will come after you.
And they can claw
You
back
can't just
against.
give away all your assets today to your kids or grandkids and then apply tomorrow for it.
Right.
I think Charles or Joe is right. I think it's a 5-year look back.
And
Maybe
they-
3 years. I think it's 5.
And they can claim against the house when you leave the property.
Yes.
My wife and I applied, and we were declined because we both have family issues with heart stuff.
Yeah.
So they would not insure us.
Okay.
Medicaid? Why? I don't understand.
No, long-term care.
Oh,
So, the
So-
FYI, if you can get it now, you should get it now if you think you'll need it.
yeah. I couldn't pick one because it's just so complicated.
It is extremely complicated.
I suggest going to a qualified financial planner, and by that, my personal preference would be to suggest somebody with a certified financial planner designation, CFP designation. You're looking for somebody who's comfortable cranking numbers, but also somebody who's comfortable across a broad range, well, across what I call the 5 pillars of financial planning. They need to be comfortable with estate plans. They need to be comfortable with insurance. They need to be comfortable with taxes and so on. So I would suggest trying to find a CFP to get some personalized advice.
Can you do one of these meetup for long-term care?
We did have one of these. Was it last month we covered the, and then yeah, last month we covered a lot of the insurance issues. We had a section on long-term care, but it's not enough to answer all your questions. And in fact, it's probably enough to trigger which questions you need to ask. I can't give you the answers for a number of reasons. Number one, it's highly personal and subjective. It depends on what's important to you, and it is complicated.
Martha just sent a chat that noted that she got her long-term care from AARP. And I've got the email and phone number for SourceWise if anybody wants that. It's
Why don't you
Wise.
enter it into the chat so there's no
Oh, okay.
mistake?
I'll do that. That's simpler. You're right.
Okay. So we've covered the 7 myths, and actually, how about this for timing? I think Holders is about ready to throw us out so that they can get the place returned to all the seating back. So the timing is working out well. I've given you here a list of websites and reading material for anybody who wants to dig a little deeper. I'm showing you my mandatory cartoon that I include in all of these. It says, just what exactly is your generation going to do about my generation's Social Security? I like that one. And Holly wanted me to include all of our websites for Meetup and Facebook and YouTube, and give you all these here. The other thing that I'd suggest that folks might have an interest in, if you go to our website, a lot of the slides are available certainly from any of these discussion groups. There's a lot of material on there that's fun to browse around. And with that, folks, I thank everybody for showing up. Tell all your friends for next time, and we look forward to seeing you then.
Thank you.
Good night, and have a great tomorrow, and stay safe.
Yeah, the
Thank you.
slides were great.
Thank you.